Last time this exact setup appeared, the market repriced the stock by nearly 200% in a matter of days. Not because earnings surprised, not because Wall Street suddenly got smarter, but because the market was forced to resolve uncertainty all at once. That same pressure point is back, and this time the clock is visible. On Christmas Eve, I published a trade alert titled, "Wall Street is quietly fighting a war over this stock," and the CEO just drew his line in the sand. There should be a link to that popping up if you want to look it over. At the time of this video, it's still a good trade. That write-up was not about hype or predictions. It focused on one thing only: insider conviction showing up during a moment of structural confusion. A CEO stepping into the open market with real money, buying common stock in size, right as Wall Street was struggling to classify what this company actually is. That setup still matters, but there is now an additional layer that deserves attention. When I first published the trade, the thesis was early by design. It centered on a structural repricing window driven by three forces: index and benchmark uncertainty, heavy positioning pressure, and a business model that does not fit cleanly into standard valuation buckets. None of that has changed. What has changed is timing. Before I explain that, take 1 second and subscribe to this channel. I share these setups before the market is forced to react, not after the headlines explain what already happened. Now here's why timing matters. Companies that sit outside traditional valuation frameworks tend to trade very differently than most stocks. When nothing is happening, price drifts. When something forces clarity, price does not negotiate. It gaps. This company has already been through that exact process before. During its last major merger event, the stock did not grind higher over weeks. Liquidity shifted, positioning snapped, and price repriced rapidly. I'm not saying history has to repeat exactly. I am saying the behavioral pattern is established. The liquidity profile is thin, and positioning remains fragile. That combination is what creates asymmetric moves. The biggest difference between December and today is that the catalyst clock is now visible. Back then, the trade was early. Now there is a defined window where new information is expected. When events like this resolve, three things usually happen. Shorts do not get time to reposition. Liquidity does not expand gradually. And price does not stair-step higher. Jumps. That is why insiders position before announcements, not after. I am not revisiting this trade to chase price. I'm doing it because this is how event-driven asymmetric trades actually unfold. Insider conviction appears. The market misprices uncertainty. A forcing mechanism approaches, and price resolves. And we are now transitioning from step 3 into step 4. That does not guarantee upside. But it does mean the window is narrowing. And by next Tuesday, it may already be too late. I laid out the full trade structure, the historical precedent, and the risk framework in the complete write-up on Market Traders Daily. If you want the full context and how this was positioned before the market reacts, the link is below. Subscribe here on YouTube, read the full report, and I will see you in the next setup.